On July 27, 1694, a group of private financiers walked into the court of King William III with a proposition that would change the course of human history. They offered to lend the English government £1.2 million to finance the war against France. In exchange, they wanted something that had never been granted to private citizens: the right to create England's money supply. King William, desperate for war funding and facing empty royal coffers, agreed to their terms. With that single decision, the English crown surrendered monetary sovereignty to private bankers who would control government finances for the next 330 years and counting. The transaction wasn't a loan, it was a purchase. The bankers didn't buy government bonds, they bought the government itself. The Bank of England became history's first central bank. But calling it a bank was deliberate misdirection. It was actually a cartel of private financiers who convinced a sovereign nation to borrow its own money supply into existence while paying interest on every pound in circulation. The scheme was so brilliant, so profitable, and so politically powerful that it became the template for every central banking system that followed. The Federal Reserve, European Central Bank, Bank of Japan, all operate according to the model established by English financiers who figured out how to make governments pay rent on their own currency. But the Bank of England wasn't created to serve England's interests. It was created to serve banker interests, while using England's military and political power for collection and enforcement. Walk through the financial district of London today, and you'll see the Bank of England building on Threadneedle Street, its facade bearing the motto, Bank of England, in gold letters. But those letters conceal the institution's true nature. It's a private corporation that has convinced the world it represents public interest while pursuing private profit. The deception has been so complete that most people, including government officials, believe central banks serve national economies rather than banker shareholders. They've forgotten that central banking began as a conspiracy by private financiers to capture government monetary authority through debt manipulation. Understanding how the conspiracy worked in 1694 explains how it continues working today. The Desperate King. King William III faced an impossible situation in 1694 that would become familiar to every government leader who followed. Unlimited expenses with limited income. The 9 Years' War against Louis XIV's France was consuming £2 million annually, while royal revenues barely exceeded £1 million. Traditional taxation couldn't bridge the gap without triggering domestic rebellion. Borrowing from foreign monarchs meant political subordination to potential enemies. Debasing the currency would destroy England's emerging commercial reputation. William needed a financing method that provided immediate cash without obvious political costs. The solution appeared when William Paterson, a Scottish financier, approached the court with an unprecedented proposal. Paterson represented a consortium of London merchants, goldsmiths, and financiers who offered to lend the government £1.2 million at 8% annual interest. But their terms included conditions that seemed innocuous but proved revolutionary. The lenders would incorporate as the Governor and Company of the Bank of England, with exclusive rights to issue banknotes backed by government debt. The arrangement appeared to solve everyone's problems. The government received immediate funding for military operations. The lenders received guaranteed returns on secure investments. The public received a stable currency backed by government promises. But the terms contained a hidden mechanism that would transfer monetary control from elected officials to private financiers. The bank would create money by purchasing government debt, meaning the money supply would expand only when the government borrowed more. This seemingly technical detail fundamentally altered the relationship between government and citizens. Instead of government creating money to serve public needs, private bankers would create money to serve government debt while collecting interest on every transaction. King William, focused on immediate military necessities, either didn't understand the long-term implications or didn't care about consequences that would affect his successors rather than his current crisis. The Paterson scheme. William Paterson understood something that escaped most government officials. Whoever controls money creation controls economic and political power, regardless of constitutional arrangements or electoral outcomes. Paterson's proposal was elegant in its simplicity. The Bank of England would lend money to the government by creating deposits on its books. The government would pay interest on these deposits while using them to fund operations. The bank would issue paper notes representing claims on the deposits, creating a circulating currency backed by government debt rather than gold or silver. The scheme solved multiple problems simultaneously. The government received financing without direct taxation. The bank received guaranteed profits from government interest payments. The public received paper currency that was more convenient than metal coins for daily transactions. But the arrangement created a dependency relationship that favored bankers over everyone else. The government could only obtain new money by borrowing it from the bank at interest. The bank could only create money by purchasing government debt. The public could only obtain currency by accepting paper claims on government obligations. Most significantly, the system ensured that the total money supply would always be less than the total debt owed to the bank. Since every pound was created through lending at interest, there would never be enough pounds in circulation to pay off all debts plus interest without creating additional debt. This mathematical impossibility became a feature, not a bug, of the Paterson scheme. Permanent government debt meant permanent bank profits. Expanding debt meant expanding bank influence. Growing interest payments meant growing bank control over government fiscal policy. Paterson had discovered the ultimate business model. Lend money that costs nothing to create, collect interest on every unit in circulation, and ensure that full repayment is mathematically impossible. The subscription scam. The Bank of England's initial capitalization revealed the sophisticated financial manipulation that would characterize central banking for centuries. The bank required £1.2 million in capital to begin operations, but subscribers only needed to provide 25% in actual gold or silver. The remaining 75% could be paid using government IOUs, old debts, or promises of future payment. This meant that £300,000 in real money leveraged into £1.2 million in bank capital, which then leveraged into unlimited money creation capacity. The founding shareholders invested a fraction of the stated capitalization, while gaining legal authority to create England's entire money supply. The subscription process was carefully managed to ensure that bank control remained concentrated among the original conspirators. Only wealthy merchants, government officials, and connected financiers could afford the minimum investment. Small investors were excluded by design. The shareholder list read like a directory of England's financial and political elite. Members of Parliament, court officials, overseas merchants, and goldsmith bankers. These individuals gained personal profit from government borrowing while holding political positions that determined government borrowing policy. The conflict of interest was obvious, but ignored because it served everyone's immediate interests. Government officials received easy financing for political projects. Bank shareholders received guaranteed profits from government operations. The public received apparent prosperity from increased money circulation. But the subscription structure ensured that monetary policy would serve shareholder interests rather than public welfare. When government needed money, bank shareholders profited. When government repaid debt, bank shareholders reinvested in new debt. When economic problems required monetary solutions, bank shareholders determined the solutions. The Bank of England wasn't created to serve England. It was created to serve its shareholders, using England's legal and military authority for collection and enforcement. The monopoly game. The Bank of England's charter included exclusive privileges that made competition impossible and profits guaranteed. Only the bank could issue paper currency in amounts exceeding £5. Only the bank could hold government deposits. Only the bank could provide government loans exceeding £100,000. Any competing institution that challenged these monopolies faced legal prosecution and financial destruction. The monopoly privileges created artificial scarcity in monetary services that enabled the bank to charge premium prices while providing minimal service. Government officials who needed financing had no alternatives. Businesses that needed currency had no options. Citizens who needed banking services had no choices. More importantly, the monopoly ensured that monetary policy would reflect bank shareholders' interests rather than competitive market forces. Interest rates, money supply, and credit availability would be determined by what maximized bank profits rather than what optimized economic performance. The bank justified its monopoly by claiming that monetary stability required central coordination rather than competitive chaos. Multiple currency issuers would create confusion. Competing credit policies would generate instability. Market-based money would lack the reliability that commerce required. But the real justification was profit protection. Monopoly privileges enabled the bank to extract maximum value from money creation while preventing market forces from reducing those profits through competition. The charter established the template that every subsequent central bank would follow. Obtain exclusive privileges through government cooperation, eliminate competition through legal barriers, maximize profits through artificial scarcity, and justify the arrangement through appeals to economic stability. The debt engine. The Bank of England's lending practices revealed the true purpose behind central banking, converting productive economic activity into permanent debt service that enriched bank shareholders while impoverishing everyone else. The bank didn't lend existing deposits like traditional banks. Instead, it created deposits through bookkeeping entries and lent the newly created money to borrowers who paid interest on money that hadn't existed before the loan. This process violated every principle of sound banking, but generated enormous profits with minimal risk. The bank created money from nothing, collected interest on the creation, and required repayment in money that other people had earned through productive labor. Government borrowing became the bank's most profitable activity. Unlike private borrowers who might default, the government could always repay by taxing citizens or borrowing additional money from the bank. Government debt was self-reinforcing because debt service required taxation that strengthened government power, while interest payments strengthened bank wealth. The relationship created a feedback loop that benefited both institutions at public expense. Government officials could fund popular programs without unpopular taxes by borrowing from the bank. Bank shareholders could earn guaranteed profits from government interest payments. Both institutions grew larger and more powerful, while productive economic activities supported increasing debt service. But the arrangement required constant expansion to remain sustainable. Government needed ever larger borrowing to service existing debt, plus fund new programs. The bank needed ever larger lending to generate sufficient profits for shareholders. The public needed ever greater productivity to support increasing debt service through taxation. The debt engine could function indefinitely, as long as economic growth exceeded debt growth. When debt growth exceeded economic growth, the mathematics became impossible, and the system would require reset through war, revolution, or currency collapse. The international template. The Bank of England's success attracted imitators across Europe who recognized the profit potential in government monetary partnerships. The Bank of France, founded in 1800, followed the English model with Napoleon's support. The Reichsbank, established in 1876, provided similar services for German unification. The Bank of Japan, created in 1882, facilitated Japan's industrial modernization through debt-based money creation. Each central bank claimed to serve national interests while actually serving banker interests. Each institution obtained monopoly privileges through government cooperation. Each organization extracted wealth from productive citizens while claiming to promote economic stability. But the Bank of England remained the template and the model for central banking expansion. English financial techniques, English legal structures, and English political arrangements became the global standard for monetary control. The Federal Reserve Act of 1913 explicitly copied the Bank of England's charter, granting similar monopoly privileges to American financiers who had studied English banking practices for decades. The Jekyll Island meeting that designed the Federal Reserve included bankers who had worked directly with Bank of England officials. The European Central Bank, established in 1999, operates according to principles first developed by Bank of England economists. The People's Bank of China, despite communist political rhetoric, functions according to central banking practices pioneered in England. Every major central bank in the world today operates according to the model established by English financiers in 1694. Private ownership, government partnership, monopoly privileges, debt-based money creation, and interest collection on currency supply. The modern continuation. The Bank of England conspiracy didn't end in 1694. It evolved and expanded until it encompassed the entire global financial system. Today's Bank of England still operates as a private corporation, despite claims of government ownership. The bank's shareholders remain anonymous under legal protections established centuries ago. The bank's profits continue flowing to private interests, despite public appearances of accountability. More significantly, the Bank of England's influence extends far beyond Britain through relationships with other central banks, international financial institutions, and global regulatory bodies. The bank provides technical assistance to developing countries, coordinates monetary policy with other central banks, and sets standards for international banking practices. The original conspiracy has become an international system where central banks cooperate to maintain monetary control, while governments believe they regulate institutions that actually regulate them. The Federal Reserve's relationship with the Bank of England demonstrates how the conspiracy operates across national boundaries. American monetary policy coordinates with British monetary policy through regular consultations, shared research, and joint interventions that serve banking interests rather than national interests. Central bank digital currencies represent the latest evolution of the original conspiracy. CBDCs would eliminate physical cash while providing central banks with complete surveillance and control over every monetary transaction. Citizens would become economic prisoners, unable to escape monitoring or intervention. The technology changes, but the fundamental relationship remains identical. Private financiers control money creation, while governments provide legal authority and enforcement power. The permanent revolution. The Bank of England conspiracy succeeded because it solved problems for government officials while creating larger problems for everyone else. Government debt became manageable through central bank financing, but total debt became unsustainable through compound interest. Economic growth became possible through money creation, but wealth inequality became extreme through inflation. Political stability became achievable through fiscal manipulation, but social instability became inevitable through economic distortion. The conspiracy created a permanent revolution in which periodic crises require increasingly extreme interventions that concentrate power while destroying the foundations of prosperity and freedom. Each crisis, war, depression, pandemic, environmental emergency, provides justification for expanded central bank authority. Each intervention, quantitative easing, negative interest rates, direct lending, normalizes previously unthinkable monetary policies. Each success, stabilized markets, contained inflation, prevented collapse, validates the system while making the next crisis larger and more dangerous. The Bank of England established a pattern that has repeated for over 3 centuries. Private interests capture public institutions through crisis management, extract wealth through monetary manipulation, and maintain control through complexity that prevents public understanding. The ultimate deception. The greatest achievement of the Bank of England conspiracy is convincing the world that central banking serves public interest rather than private profit. Modern economics textbooks describe central banks as essential institutions that stabilize currencies, regulate inflation, and prevent financial crises. Government officials claim central bank independence as a virtue that prevents political manipulation of monetary policy. Media coverage treats central bankers as wise technocrats who sacrifice personal gain for public service. But the historical record reveals the opposite truth. Central banks were created by private financiers to capture government monetary authority, extract wealth from productive citizens, and maintain control through deliberate complexity that prevents democratic accountability. The deception has been so successful that even critics of central banking typically propose reforms rather than abolition, regulation rather than elimination, transparency rather than termination. Few recognize that central banking is inherently corrupt because it grants private institutions the power to create public money while collecting private profit from government debt that citizens must repay through taxation. The Bank of England conspiracy wasn't a historical anomaly that ended centuries ago. It was the beginning of a system that has expanded until it controls the global economy while claiming to serve the public interest. Understanding how the conspiracy began explains how it continues, and why it will persist until mathematical impossibilities force reset through collapse or revolution. The private bankers who bought the English government in 1694 established a template that now governs every major economy on Earth. They didn't just create a central bank, they created the future. And that future is still unfolding according to their plan.